And we are live on Oz Property Investors. We have bring the big names and we have the big fun. And Joe and I were trying to figure out how to intro each other. But we are live. What's happening, Mr. Tucker? Where are you today? In Adelaide.
This is not my usual setup. There were trams in my little periphery, but no, not Adelaide. I am in Melbourne, checking out the sites down here. So if you're not on a plane, what are you doing? You should be buying property. You need to go to the place and check it out. But how are you, Jeff? How are you, mate?
Yeah. I was doing some research for this afternoon and even sort of last night, and just I really enjoy this part of what I do. So I'm going really well, and just some really exciting things coming up over the next 3 to 6 months, personally, professionally, and all that's good things. So, but I think this session is going to be really great because it's the kind of conversation that I think people should be considering, and we're not. I don't know. I asked Joe if he could prepare the financial advice slide. Have you got that slide, Joe? But
Sure.
didn't even test the sponsor. Okay, so I'll just say, this is not anything we say here is not financial advice, folks. So, of course, but any questions, comments, throw those in because we're going to have a Q&A. But that's a long soliloquy, Joe. So
That's a very long soliloquy. But we do not give out financial advice, but we do bust myths here. And that is the biggest thing that we are looking to do. There are a number of property myths that people see out there in the big wide world and take as gospel. So we are trying to just look at it subjectively and say, look at the data and say, well, what other things we're going to cover off? Are we going to talk about the topics right now, Jeff, or do we want to leave that for?
Let's talk about one each, and then we can kind of leave a bit of intrigue and mystique. So what's the? I'll talk about my first one is going to be about the interest rates crash the property market. So very controversial, I know, particularly it's rising interest rates at the moment. I thought so. I'm going to be talking about that and just I'll define a few things as well, and we were talking about this before the show. How about you? What's one you want to share at the moment?
I want to share this.
Oh, you found it. There you go.
Found it. This is not financial advice. This is just us busting myths and chatting about property. So do not take any of this as that. But my myth is all around population growth. I think population growth is one of those ones where people look at the data and they look at the ABS stats and they're like, oh my gosh, this place is growing 20%. This is going to be a place where I should be putting my money. And you see it a lot with spruikers as well. So my myth is, does population growth equal capital growth?
Yeah, that's an interesting one. I was talking to you about that today, and I said, Joe, I'm interested to see how you bust that myth. But let's bust a move and bust a myth. Why not? Actually, before we get into it though, did you see there's some interesting sort of in the financial markets? Or see the US CPI ended up being 8.3 instead of expectation of 8.1. And the US stock market tanked 4%, or the Dow Jones. I was like, wow, that's insane, isn't it?
Yeah. People are the sentiment is very interesting. People are getting a little bit worried about their money. But it's a very, very interesting how that happened. I have no idea why it would drop so much when it's just a 0.2% increase.
Well, 0.2 above expectation. So I think it's the kind of it's kind of the narrative. Yeah, because it's kind of the narrative. Everybody's like, oh, it's going. Yeah, but anyway, we could talk about this with a few beers and all that. We're armchair economists here at Oz, or somewhat Ozprop. So, what is your quote of the week, Mr. Tucker? What do you want me to go
My quote of the week is brought to you by Furphy. It says here, never let the truth get in the way of a good story. So I've got this one near and dear. I'm in Victoria, so I thought, why not have a Victorian beer? And it's very true. Like these myths, I think you're echoing a bit, Jeff. Turn your thing down a bit. Okay. But yeah, these myths that we're about to bust are stories, right? These are stories that people have been telling the market and been getting away with certain things. And that's one thing they have to look to the data around what is actually the truth. And that's what we're going to do today. So let's do that, Jeff.
I think mine is sort of somewhat half truths. I wouldn't say they're half myths, because you can, and that's why I suppose essentially that's what perpetuates the myth, because you can point to things and say, well, yes, I saw this happen, and this is what happened. And we'll say, well, actually, in that situation, maybe yes, it did happen, but I think that's kind of correlation doesn't always equal causation. So that leads into my quote of the week is that I've got two because why not? Because we only got two. We don't have a guest this week. It's Joe and myself. We've got myths are stories that express meaning, morality, or motivation. Whether they're true or not is irrelevant. It's controversial, I know, because we're going to bust these, and we're saying that this whole that's from an American science fiction writer, Michael Shermer. So that was an interesting because I just sort of said, well, okay, we're going to talk about this, but you have to really look behind the myth and understand, or dig behind it, and sort of rather than just taking something at face value.
Dig deep. What's your second quote?
So mine is, it's by Barbara Streisand. So excuse the hyperbole in what she says. So she says myths are a waste of time. They prevent progression. So that actually, I think that's kind of reasonable because people get fixated on yes, population growth equals can equal capital growth, interest rates rising equals or may equal property crash. They get kind of caught up in the noise, caught up in the rhetoric.
Mate, let's dive in. I'm excited to bust some myths here.
Commercial property offers the highest cash flow in Australian property investing, offering exceptionally higher yields than residential. Now, we're talking 8 to 10% net yields. That's cash after all expenses, not this 2 to 6% gross that we see in the residential space. So for those that are starting out on their commercial investing journey, it can be exciting, but it's also a step not to be taken lightly. The expertise of a commercial buyer's agent can pay dividends to help you secure that high cash flow and high growth potential property. And this is why we recommend Steve Polisi of Polisi Property. With over 6 years experience in the space, Steve has over 1,200 property transactions under his belt. He has seen it all and knows the best locations right for growth. In a previous life, Steve was a chartered mechanical and structural engineer, so he draws on his mathematical and analytical skills that he's developed to break down what works best in commercial property. As with engineering, same goes with commercial property. It's based primarily on the numbers. So if you're curious about diversifying into commercial property, you have access to $100,000 in cash or in equity, book a call with Steve today and find that perfect asset for you.
There we go. That is, good old. There's been a couple of. We've got. Here you go, Tucker's. Here you go. So yeah, that was. I mean, good old commercial. I'm sure there's some myths going on. We'd have to get Polisi to unpack those. It could be. I think we did sort of talk about those a bit. So we're going to try something a little bit unique here. We're going to introduce each other. So I was quickly trying to look up LinkedIn to see what. But you, so if you. Yeah, I know what you've done, Joe, but you were the head of Australia's one of Australia's largest what law tech, or was it
legal tech? Yeah,
legal tech. Okay, yeah, legal
sales.
Tech. So you were the head of sales. Head of sales, and you were doing that for I think at least 5 to 6. You were doing it for quite some time, and you decided that you loved you do love property, so you have a multi-million-dollar portfolio. You're a finalist in the 2022, was it the New South Wales? No, with the Small Business Australia Awards?
Small Business Championship Awards. Yeah, small business.
Yeah. Man, that looked like a great night. It looked like a good fun. And you look like
Peter Overton was yelling out my business name saying, here we go. Don't come up to the stage and collect a prize. You're a finalist. But you didn't win.
Oh, well, that's still nice. But yeah, and you now head up property principal, so you've absolutely been growing crazy and really just buying some fantastic deals, and one of which we'll probably talk about later on tonight, I believe. So, but yeah, that's me. Did I nail? How did I go?
That's a wonderful introduction, Jeff. I feel like you've been practicing that in front of a mirror for the last 45 years.
Superman pose,
yeah. Well done. But yes, that was a fantastic introduction to me. I don't know what I say after an introduction, so I want to introduce you guys to Jeff Miles. He is the other half of Oz Property Investors. He is former mortgage broker, property developer, the man that has done several renovations and cracking through property developments, currently working on a renovation on his own house, and the man that co-created Oz Property Investors, Jeff Miles, here to bust some myths. So let's dive in, mate. We've been talking about these myths. It's 10 minutes in. These poor people. one thing that I want everyone in the audience to do, it's only two of us. We don't have anyone else to bounce stuff off of. So we need more audience interaction. And so we are going to talk out, we're going to say a myth or a thing that's said and say either agree or myth like busted or confirmed. That's it. So busted means no, this is incorrect, or confirmed is yes, this is absolutely the truth. So let's do that. Jef, myth number one. What is myth number one? Let's crack on.
I'm going to bring it up on the screen. Rising interest rates crashes the property market.
Okay.
I'm going to bring it up on the screen so it's easier for. Okay. Here we go.
Let's hope we're not live. So is that a confirmed yes? Rising interest rates crash the property market, or no?
So I'm gonna. Well, I mean, we're talking about myths. So that to me is largely a myth. So let's define a few things though, because everybody's gonna be like, okay, great. Like, yes, you've just made this big kind of bold statement, and people know that. And I've done some research on this. So first off, when we say the property market, so I'm gonna say that this is the Australian property market. So of course, markets in markets. So if you looked at, I'm trying to pick a market that really didn't perform well. There's some of the blue chip that really don't perform that well in rising interest rates, and I could go into why that's a myth, not a myth, but why that's a bit of a misnomer. But some of those you will see and I'm going to define a crash as over 30% reduction in price. So Joe and I are talking. So I think anything because 10% in share terms is a correction, and I sort of think 20% is sort of halfway to a crash, and I think 30% or more is what off the median. So I think that's and I wanted to dispel, and I've actually got the numbers as to how much since we had the first rate increase, how much the capital markets have gone down. But let's get into where I sort of formed a view for this one as to why it's a myth. So I've got some resources I'm going to share. We get in the comments, so people. I mean, I'm
definitely
not
the lack.
I'll get trapped.
Definitely not the lack of availability. Credit availability plays a bigger role.
That's definitely. I mean, that's one of, and that's the thing I'm going to get at as well, because if and this is the article, Stephen Cook. This is from a couple of months ago, but there are, and that's the kind of thing. Even though interest rates may contribute, and I think a crash is a bit extreme. Joe and I were talking about this before. Has there ever been a wide Australian market that's gone down 30%? And I think there was one in about the 50s or something, as in the nationwide, the Australian property market, not just. I'm sure there's mining towns that have probably dropped that much and double that maybe even as well. But let's get into this. So what I'm sort of unpacking is the times in history, or Australian history at least, up in the last sort of 30 years, where we've actually seen a rates and interest rate hiking cycle. So we're sort of looking from.
So we had this on our newsletter. Jef, can you zoom in a bit on your page?
I can.
Zoom.
Is that zoomed enough?
Perfect. Yep.
Hold my beer.
Okay, so there's been 4 instances in the last 30 years where the RBA has implemented an interest rate cycle. So 1994, August to December 1944, and that went from 275 basis points.
1990. Yeah. You said 1944, did you?
1994.
Yeah. Anyway, yeah. And then you had, so that one was the recession that we had to have apparently. So not apparently, I was running around almost in nappies, so to speak. But yeah, that one was I wasn't quite I can't quite remember that one. But the next one in 1999 to August 2000. So note that the first two are relatively quick ones, and the last one was also a quick one. And the May 2002 to March 2008 was over an extended period. So I think that you're seeing multiple sort of scenarios playing out there. But that one here would have been in response to the .com sort of bubble that was starting to frop up, mostly in America. But I think that sort of saw a lot of frenzy and a lot of sort of price increases, and just an overheating economy, because that's typically why the RBA would look to increase. Typically, they're looking to increase rates to slow down slow down the economy and decrease potentially inflation. Not that they saw inflationary times. So these last two, I believe, were in response. So actually, we'll go to the cash rate sort of
So
thing.
what is this telling us? It's saying that there have been these instances of interest rates going up, essentially. So we're saying over a 6-year period, interest rates went up, and then in each of these 4 cycles, house prices were flat or higher, both 1 or 2 years after the first rate hike. So 1 or 2 years after the first rate hike, 5 years after the first rate hike in each cycle, house prices were up on average 40% higher. So yeah, that's what I like about this little myth that you've got here is looking at it over the long term and not just looking at it over the short term as well. It's
But let's sort of even we'll go and we'll look at the other thing that I found was interesting is yes, that's sort of because that's giving it plenty of time to actually digest and sort of and with that one in particular, so October, so 1 year after the first hike, that would have been October of 2010. So they wouldn't have even stopped increasing. So if you look 2 years after, it was actually 0.2. So there was a bit of a lag. But this one here in 2002, that's an interesting one because look, 2 years after, the in two of them, they've just absolutely. I mean that would sort of would have been impacted likely by the GFC and sort of Australian economy was going absolute gangbusters. Like we were exporting a lot of materials. So the interesting thing though is Joe, is here what we've got is this is after the last rate increase of that particular cycle. So this would be November 2011. You can sort of see that, yes, prices did actually go down a year after, and same as the 2008, which coincided with the GFC though, or somewhat with the GFC. I mean, this would have been somewhat impacted. This definitely would have been impacted by some negative sentiment around the global financial crisis of 2008, 2009. So,
Okay.
But look at that. Like, so 5 years after the last hike, and we can see in some instances the March 2008 one, so that would have been March 2013. So it didn't exactly shoot the lights out in that sort of 5-year period. But
well, it did after the GFC. So Australian house values after during the GFC, so just after they have it on that screen, went down 7.5% over the 2008 calendar year. In the US, they went down 17%. The UK went down 11%, and New Zealand went down 8%.
There you go, Joe. Good research.
Mate,
so let's actually look at, because I wanted to sort of contextualize and show the various cities as well. So I won't do this for every single one. I'll just do it for one of these. Let's pick the worst one, because I want to be ultra conservative and say, well, yep. So let's look at November 2010. I can go. This is a nifty little chart that shows the house prices in Australia over 50 years.
You want to zoom in again?
I'll zoom in. Yeah, it's too small. Jeez. There we go. Is that good enough, Joe?
Yeah.
I'll get rid of that. So I feel like I've taken a long time just on this one myth. But we had November 2010. So we had 2010 there. That's around November. So if we go up here, we can sort of see that Sydney's at 570 odd thousand. Darwin, this is a crazy one. Darwin was the second most expensive property market in Australia at the end of 2010. It's just amazing, isn't it? And Hobart was by far the cheapest, and Adelaide as well. So, and even Brisbane. So if we fast forward, I just want to illustrate this, and then we'll move on to your first.
Don't fast forward. Just hit play. See that play button on the left hand side?
Oh, you can, but I like to actually, I like to go to 20. Let's go to 20. This is roughly the end of 2011, so November. So we sort of see here, it's almost sort of tracked sideways, roughly. If we go from...
So what was it, 571? So it hasn't really moved.
580. So it's gone up roughly, I don't know, what's that? That's 0.2%. The Sydney one has gone up. Darwin sort of gone up a little bit more. Hobart went back a little bit because that was at 330, and Adelaide sort of trod water. Brisbane. So they largely sort of stayed flat over that 1 year period. So I don't So where they take the numbers from is vitally important, because this one takes the numbers from the using a quarterly ABS data. So I can't actually. So this is ABS for house prices past. So Australian Bureau. So in theory they use the same statistics. So comparing apples of apples.
Can we play
there you
it
go.
from? Can you play it from the longest period of interest rate rises? So go back into
2002. Yep.
Yeah, go to 2002 and then just hit play. So hit it from where interest rates started to rise and see what happens.
Okay, so May 2022, May 2002. That's roughly about May. So looking at Sydney was at 434.
And when did it stop? 2008. So let's just see what happens to prices.
So Sydney had a bit of a
Sydney's on the run. Canberra's doing pretty well though.
Yeah,
Perth is coming up the coming up the inside. We have
commodities
boom. I don't do the horses, but I feel like this is. Look, Darwin's coming up again. Yeah. Oh my good Lord.
So that's roughly around the last rates. That was in what we're looking at. We're looking at March 2000. Sorry, it was March 2008. So you sort of see there, Sydney kind of, the rest of them actually performed quite well, but that's going to fall into my myth coming up about Sydney. Well, not just about Sydney, but yeah. So there you go, Joe. What are everybody's thoughts about that particular myth being busted?
That myth being busted. Very interesting is apparently
very interesting. What did you find interesting? The thing that I wanted to, because we've seen, so we've gone from 0.1% now to 2.35%. So we've gone up 2.25% in a matter of May, June, July, August, and September. So in 5 months, we've increased the cash rate 2.25%. So just quickly before we get onto, didn't take as long as I thought, Joe. I was actually pretty impressed with my time management there. Good stuff.
Great time management.
Well,
one of the things I guess is that people are getting a little bit excited on the whole interest rate side of things is that it's just one part of the situation, right? We still have very little supply of properties available. We still have a lot of people coming to Australia that are going to need housing. We just let in 80,000 more skilled migrants to be able to do, to work in the country. The supply of property is not coming on the market as fast as it should, because houses aren't being built fast as they should, because there is a massive labor shortage and there's a massive material increase and material shortage. So prices for those things are going up. So like the underlying, but what happens is, right, like if we, I'm just going to share my screen real quick, Jeff.
Okay.
And just kind of take over just a quick sec. But I wanted to show this page here. And talk about the first home buyer announced October 2008, where prices started to rise. So we just had the GFC, then the government. Oh wait, no, that's not the one. Oh, hang on. Now this is embarrassing. It's not the right one.
Are you using a different?
Yeah, I was using a different chart. There was a section where, anyway, I'm going back. I'm backpedaling. Okay. I'm bringing yours right back up, Jeff.
Okay.
But no, what it was the access to credit is what helped stem the capital growth of the property market. So, like exactly what we had during COVID, we had very tight supply. We had people wanting to go out into the more lifestyle regional locations. But we also printed $260 billion that was funneled into the economy that needed to go somewhere, and it just bulked up people's savings, and they then put those savings into property.
I think that's I don't know if there was any stimulatory back in the previous rates cycle sort of increases, but I think this time the old saying, history doesn't repeat, but it rhymes. I don't know if that actually applies here, because we've printed a truckload of money, and they are sort of starting to use quantitative tightening, and I don't believe there's been because quantitative easing sort of came, and correct me if I'm wrong, I'm not an economist, but and I'm not all these other things that people say they are. But 2008 was when they sort of started to introduce quantitative easing to get sort of money circulating around the economy to make sure there wasn't a complete sort of freeze of liquidity in capital markets. So I don't know if there's ever, in Australia at least, been a cycle of interest rate rising where they've also tightened the money supply. I mean, they've perhaps after there's been a significant expansion of money supply. So that in itself could mean that, yes, that we may see a more volatile bump, as we're sort of seeing here. I wanted to bring this up. So this is the CoreLogic monthly numbers. So since May the 1st, Sydney has, and this is the median, so not all markets, but 7.2% for Sydney down. Melbourne is
what are you talking
down 4.5. Even this is Brisbane here, we're down 1.7. Adelaide's faring actually positive. I think they're one of the only. This one is Perth's not going too bad at 1%. So but if you look at, so this is my last point. So if you look at this is the capital cities as a whole. So capital cities have only declined, I must say only, so 2.6%. So yes, 2.6%. We're seeing people say that there's absolutely
what period
over the since they've started to increase interest rates over the last 4 months.
Okay. And what is that in real terms? So look at the top
Dollars.
number and the bottom number and minus it. Yeah. So 940. So that's
$30,000. So it's not an insignificant amount, but at the same time, if you look at what it started, let's look at the start of 2021. So from the start of 2021 to when it sort of its absolute peak, it increased over $200,000.
Wow.
Even regionals as well. Regionals increased $150,000, roughly. So
yeah.
So there you go. Yeah. So let's get on to. So I don't know if that's kind of gives some interesting.
That's super useful. I found the little area that I wanted to talk about, but it was actually in the reverse. So it's when APRA introduced their availability, the access limited 30% interest only. APRA announces that.
So they need capped investors.
They're trying to slow down investment. APRA announces 10% spending limit on investment lending. When the market starts to get hot, we start to get APRA involved. We start to get banks involved. We get people putting caps on the amount of liquidity that can go into the market. And people that say that interest rates have no relevance to capital growth are absolutely wrong, because there is the market sentiment of people saying, like, I have people saying to me right now, Joe, we need to get better cash flow positive properties because I'm scared about the rate increases. But that means those people are going to buy different assets, which is going to move the money that is out there into a different location. And there isn't enough. And there are people that are saying, no, interest rates are going to rise. So it is going to slow the market down. But I don't see it crashing the market, but it is going to stop the amount of capital that's going to flow into it until things start to even out. And I do see one thing that I wanted to mention is I'm pretty sure every single December there has been 0 interest rate rises. The RBA doesn't want to give you everyone over Christmas a terrible lump of coal.
That's actually sorry, Joe. I think you're wrong on that. Sorry, mate. I'm going to have to say that's not correct.
Incorrect?
They did a jumbo increase, I believe. So as a Christmas present in 1994, they increased rates 1%. So on the 14th of December 1994. The interest rate, that's when that recession we had to have. It went from 6.5% cash rate to 7.5%.
Okay, well there you go. They were really
but
sure
typically, yeah. Sorry,
typically they don't.
Sorry.
Yeah, that myth busted.
I actually heard that the other day.
Yeah. So, and also in January there isn't a rate rise announcement in January. So,
Yeah.
I'm seeing there be a bit of a lag in between December and January, where there's a little bit of a cool off. They're then going to have September, October data, and they can start to see what this is actually doing to the economy, where everyone stands, what the inflation numbers are at, and all of that good stuff.
Yeah. There we go. So Joe, what is your everybody? I really got geeked out a bit.
Oh yeah, okay. Everyone, throw in the comments "busted," as in busted, or confirmed, and then if you write confirmed, write a little spiel about why interest
Give us some
rates crash
feedback, folks.
property markets.
But so Joe, what's your first myth?
I think I put it in the banner there. Yep.
Let's bring it up.
Bring it up. Population growth means capital growth. So this is the theory, right? If an area is growing in population, that means there's more demand for it, which means prices will go up, right? This is one of the greatest marketing tools banded around. And really, it's just implying strong population growth gives you future capital growth. But in its simplest form, it kind of passes the test. Yeah, more people are coming into the place. That means it's going to work, right? And I guess most people think population growth is a key indicator of demand. So if the population is growing, there's going to be huge demand. But I guess the way to view population growth is more of an indicator of supply. So if there's a strong population growth, there must be a lot of available properties for people to move into. So that's one of the things that I wanted to talk to is it's not actually. So just think of a different market, right? Think of Bondi, for instance. No more people, not really many more people can move into Bondi.
They can't, no.
That still the houses are continuing, like the values of the properties are continue to going up. What I am going to do is share my screen with some data that I've pulled for areas that have the largest population growth. So looking at population growth over an SA3 level, a suburb, Queensland had a whole heap of people moving moving from Melbourne and Sydney up into Queensland. That's valuable information to know. But as soon as you start to drill down deeper into the suburb level, it becomes a lot harder and a lot less useful for you. So the only way the place can, an area can grow is if there are more dwellings that are being built. So people don't just, they don't just move into the street and just hang around or move into cardboard boxes. There needs to be a vacant place for them to move into. So I wanted to share some data with you, and I imagine you probably know some of these areas, Jeff, but I can't imagine it's an area where you would invest too much.
Is it the area we used to sort of have poke a bit of fun at?
No. Yeah. So this is my pulled straight from projected population medium series by SA2, SA3, and SA4 in Queensland.
Go bought out the big guns.
And these are the suburbs that have the total growth percentage. So the suburb with the most predicted growth percentage. Now, obviously, it's coming off a low base, 4,000 to 126,000. So the government has created this thing called a growth. I don't need to a growth corridor, but that growth corridor is not really a growth corridor. It's a supply corridor.
Yeah.
What do you think, Jeff? What do you think of that?
Yeah, I tend to agree because it's a sort of thing that you do hear on various sort of marketing campaigns about population growth and all that sort of thing. And typically in a lot of these areas they'll be building very cookie cutter newer stock. I'm not saying Ripley is all brand new house and land packages, but if it's not, well, I suppose if people are going to move there. And there isn't, and you're talking tens of thousands of people. It's not feasible for them to be existing properties. There needs to be, I suppose, an expansion of supply of houses, I think.
Yeah. So this is the absolute winner with projected growth of 102%. We have from the beginning to the end, we've got 25% year-on-year growth. Ripley. And here is what is in Ripley. So is this going to be an area that you're going to invest in? There is a whole heap of green fields everywhere. There are new developments getting built as we speak all over the place. There is no way that you're going to want to put some money. Well, there's no way I'm going to want to put any money around here because there's no tightening. There's no supply constraints. There is more and more supply getting built out. So eventually what will happen is Ripley's going to get super built out. And then eventually over that 40 years, it will get to a point where people will actually, prices will get to a point and they won't be able to build anymore. And then it will go crazy.
Can I be a bit a little bit cheeky, Joe? I know you weren't that cheeky with me, so
okay.
Because I'm looking at it now, and I think you and I probably both knew this, but the growth in Ripley is 40% in the last 12 months. So I suppose for those people that had invested in Ripley, or you've probably been to Ripley, haven't you?
No, it's out in Ipswich area.
Oh, Ipswich. Okay.
Not saying Ipswich is a bad area to invest in, but
I thought it was.
Wait, isn't it? Yeah. Don't do me like that, Jeff. Yeah.
No. Yeah. Okay. Yeah. Sorry, I was getting mixed up.
So it's here.
Yeah.
So yes. Yeah. Exactly. So if you look at it, this is the problem with some looking at data in isolation, exactly like you do with the interest rates. If you look at, it's had 40% growth. Well, how many properties sold? Was it like the type of asset that you could go out and buy there? Or is it just house and land packages that are getting built? But yeah, if you can have 40% growth, I would take that any day of the week.
Just having a look to see what kind of stock is. Yeah. Anyway, I can't help myself when I hear about this. So I want to understand what's going on there, because I think if there's anything that we can take away from tonight's myth busting session, I think it's important to sort of dig behind the reasoning why, because anybody can just sort of say, oh yes, population equals capital growth, but what is the driver behind that sort of thesis? Because if you can't if it's simply just sort of saying, oh, well, there's more people moving to an area, yeah, great, but okay, if there's 100,000 properties built, but there's only 50,000 people moving there, then there's going to be an imbalance between supply and demand. There's going to be more supply than demand, which generally is going to push prices down.
Yeah, and that's someone put it here very well. The houses have to be built before the population increase. Therefore, there's supply entering the market before there's demand. So there are better things to look at, better data metrics to look at than just ABS. Like government statistics that have been projected out over the last 4 years to go into the future. Like look at things like vacancy rate and supply levels and listing levels. That's going to give you a truer representation of what's actually happening in the suburb. It's good to know how many people are coming to the overall area and that it's not declining, because if an area is declining in population, like if something hasn't really moved much in population, if it's got, a 1% population growth in the last 3 years, not necessarily a bad thing. But if things are sliding backwards and it's 0.1 and then 1, -1, and it keeps going down, that means there's going to be more houses available, which opens up the supply, which then means more people aren't moving to that area as much as possible. And then the prices are going to drop. So it's one of these ones where don't look and trust it in isolation, and beware of the spruikers that are going to be saying, hey, look, population, like exactly like what I'm saying here. I would like to own in Ripley when there's only 4,000 in 2016, and now there's 126,000 people there. That's pretty good, but you've got to be careful of doing that, because it's going to be a very, very long-term hold, and there are better opportunities in tighter held markets. So are we myth busted on that one, or myth confirmed on population growth means capital growth?
Yeah, we'll give people a couple. We're already at 40 minutes show, and you worried there wasn't going to be enough content. I'm going to absolutely have to rip through my my second myth, because I want to get to the.
What is your hang on, look what's saying. All we've got is Bondi is king. So we.
Oh, okay. Is Mike, Mr. Mike? Is he English? Is he? I didn't know, but
oh, look at this. You're a good guy, Joe. Look at that. That's all we need.
BA Spruiking Ripley.
BA Spruiking Ripley. There you go.
I think there's potential busted. I think there's potential. I don't want to completely throw out the baby with the bathwater. Okay. Let's get on to my one. Otherwise, I'll get on a long kind of rant. Get on the soapbox.
Get off your soapbox, man. Get off it.
Yeah. I'll get off it. So he's one that you love to hear, like Uncle Jim or Auntie Jan talk about property. I bought this property and it doubled in 6 months or whatever it is, or 6 years, and they talk about. They say as if they were able to predict that's what happened. So I think, rather than say that this is a complete myth, because yes, it can double, I want to say property may double, because I can show there's multiple examples. So I'm gonna sort of rip through this one pretty quickly, because I want to get to Q&A and really just sort of give and also see the case study. So I'm going to share a screen, because here's something I prepared earlier.
Get the chicken out the oven, guy.
Yeah, yep. So if we have a look at the. Let's have a look. So I'm not going to run through it. As in, I'm not going to do the timing. Like, so I actually have to remember the time periods. So I'll go through to here anyway. Let's have a look. I'm gonna share. This is what goes on behind the scenes. So here's my data
questions. Look how much Jef prepares.
Yeah.
And then these are my questions for Jef. Why does Jef look so good in board shorts?
Yeah. So if we look at for Sydney, so good old King. So everybody says, well, not everybody, but there's some people in the group that poke a bit of fun about Sydney being king. And so I looked at that. So from 2002 in Sydney. So if we go down, I'm going to sort of try and pick this out. So look at the start of 2002. So Sydney was absolutely out front. It was kind of miles ahead of everybody else, just over 403,000. And this is non-inflation adjusted dollars. And if we go 10 years from now to 2012, we sort of see Sydney at 602,000. So that, I don't know about you, but that's certainly not, so double 400. Apparently I'm not a maths teacher. And I said that in a comment. If you know, you know. But so it went up 50% roughly from 400,000 to 600,000. You can sort of see that Darwin and Perth, Darwin pretty much did catch Sydney. So we sort of see that there. So that's, I suppose that clearly it hasn't doubled. And then of course we all know what happened then. I will play this out just quickly to sort of show what happened to Sydney. Look at that. In 2012 alone, absolutely sort of rocketed ahead, and Darwin just was really so look at that.
So what made Sydney do that?
Yeah, it's an interesting question. There's people that sort of, so we look at in 3 years, so it went from 600 to 900. So you pretty much saw another 50% growth in the space of almost 3 years. So I think Sydney, being Australia's largest capital city, which is almost about to be overtaken by Melbourne in terms of population, and we know that population doesn't equal capital growth. Yes, we just busted that one. But being Australia's largest city, the economy and just the scarcity largely of land in Sydney, and it is sat there for 10 years and not done too much. So you sort of, a lot of property will generally move in cycles. That's not to say that because I know that Perth I've got an example about Perth. So my thesis is that there was people that were sort of saying, well, this is now looking quite affordable. It hasn't absolutely sort of boomed too much, and it was kind of the perfect storm. Interest rates were going down, which we sort of say going up doesn't increase, but access to capital probably just got a lot easier. People's wages increased, so it was kind of sort of somewhat the perfect storm. So I would say macro conditions.
Is there a situation? Is there a 10-year period where houses doubled doubled in 10 years? Like, is there a situation? Because I think I was reading the same stuff that you were reading, and Sydney almost cracked 90. They got to 97%, so they almost doubled at one stage. in a 10-year period. But there's actually never been an overall, and this is the thing, right? I was talking to someone in the group actually about this the other day, and he said, we're looking at all these numbers and we're looking at all this data and we're looking at all these statistics on averages, right? The average Sydney house is or the median Sydney house is 600,000 or 800,000 or $1 million or whatever it may be. And he was saying that if I've got my head in the oven, my head in the oven.
Jeez, I hope you haven't got a head in the oven. Jesus.
Yeah, my feet in the freezer. On average, I'm pretty fine. I'm okay.
Yeah, that's probably not going to work out too well.
It's a good indicator, because we're looking at all these crazy numbers here, but there are all markets within markets where areas like what we're talking about. We're talking about the Sydney market going down, the Melbourne market going down, Adelaide holding its own just a little bit. But the markets that you specifically focus on that still have high demand are still hard to buy in. Like, it's very hard to buy in some of these places.
Yeah, and it's somewhat of a misnomer, because yes, you can actually see median prices dropping in a suburb quite a decent drop in sort of the bluer chip areas, but it's because the properties that are transacting at that time are potentially the lower value. Because if you've got, let's just say you've got a couple of $5 million properties and you've got a $2 or $3 million property, obviously that's going to bring the median down if you have enough of those $2 and $3 million property houses.
This is what I wanted to show that's relevant to this. Combined capitals, houses, and unit values 30 years to July 2022. So over 30 years, they grew 431%. Sorry, 453%. So 435 divided by 30 years is that 14.5% growth per year.
Yeah, which is certainly doubling every 10 years, Joe.
It's definitely, yeah. Maybe that's where the myth comes from, because it has to come from somewhere. Because look here, from July 1992,
these things that I'm showing here is, I believe they're actually dwelling housing prices.
I'm on my screen, mate. I'm on mine, mate. We're not on yours anymore. We've moved on.
Yeah,
have a look on my screen. So this here over 30 years. But here you've got from July 92 to 2002 grew 89%. So that's 10 years. That grew 89. It's kind of close. From July 2 to July 12, it only grew 60 and 82% from July 12 and 22.
I think the thing that's caused a lot of the, and I looked at the early charts in the one I sort of saw, it went from 30,000. I'll quickly share mine again. We'll get onto your second myth. But the one that I wanted to point out is, and then in a lot of this stuff that I'm sharing, yes, I am sort of deliberately picking out, because anybody could sort of pick out something and say, well, it's doubled in 4 years. Anybody could pick out that time period, but then how did it go over did it go back? The one I wanted to sort of point out, it started off in 2009, is look at Perth here. So 475,000, give or take. And look at this in 2019.
Okay, so this is Perth. Perth had a resources boom from 2004 to 2011, where it was pumping. So
and look at that. So it increased roughly $5,000 in the space of
from when?
From 2009.
2000. So just hit play on that and just watch Perth.
Yeah. We'll go back to exactly 2009. So let's see. So so 475 it was.
So we're falling behind.
But it still increased. It did increase, and then it started going backwards, and it just kind of went up a little bit. The resources were starting to really peak out now. So Perth did keep going for a little bit.
Now it's just kind of stagnating.
Yeah.
Sydney's taken. It's such an interesting chart to watch.
Yeah. Yep.
And now watch Hobart start to tear away.
Yeah. Absolutely. Yeah. Hobart was lagging.
It's supply. Why did Hobart do so well? Because they haven't got enough houses there. They just don't have enough houses for the people that are moving there.
Yeah. But then the thing that I wanted to also point out is, and I'm going to pull out a particular house in a suburb near mine. I didn't have the capacity to log into the suburb profile, but this is quite a particular affluent suburb close by. And if we look, and again, it's not over the same time period, but we'll look at past sales. So you look here, and I suspect this may have been the land sale, because 80,000 for a property in 1998 just seemed ridiculous. So I think this is when it and I don't think it would have went up 6 times in 15 years. So I think this is the build. So it was a brand new built in 2000, but then I reckon it would have been probably worth maybe 2 or 3, let's say high 2s, early 3s in the 2000. Yeah. And then so it's doubled so it's sort of doubled and then some in your sort of your 10-ish year period. And then look at this, it's almost tripled, and maybe this is sold at under market, but look at that, 1.6 million.
Oh god.
Compared to But I mean, and this is the exception to the rule. And what I wanted to point out there is that it's important to sort of, you can look at what we were looking at initially and largely is the city medians. So you sort of you can actually outperform, and it's an imperfect market. And Joe says this a lot as well. So
yeah, well, and this is one of the things that I think is the most important for people is it is very hard to align your money, your serviceability, your borrowing capacity, your ability to spend the time, energy, and effort to go out there and find a property. So if you're ready to buy a property, what is a bigger risk? Buying a property that you're going to hold for the next 30 years because you're building out a portfolio that's going to sustain you into retirement, or just trying to time them up then like buying it, not buying it and waiting for the crash, right? We're waiting for the crash. We want prices to dip. I literally bought a property off someone 3 weeks ago, and they said, we're waiting for the property market to crash. You guys are idiots buying this. I negotiated it down $20,000 off the purchase price as well. And so I already got a discount off the price. And they're like, no, we're going to be buying back in 2 years after the market drops 30%. And it's like, but what if it doesn't? You've just put all your eggs in this basket of it crashing. And then what will happen is in 6 months' time, your partner will lose their job. You'll have a baby. Your deposit will get spent on a holiday. Like, then you move property to the less important things. And Jeff and I were talking about this actually just today. Like, there was a big boom and hype about property investing when we created this group, right? We were just going through one of the largest booms. And maybe that's why Jeff and I were saying, like, we're starting to see the group kind of slow down a little bit. There's a lot less people joining at a ferocious pace that people have been before. But it's because I invest in property for a 6% growth rate. Like, I don't buy property for a 20% growth rate year on year. I just want my average. I just want a nice little steady, 5.8, 6%. That's going to get me to my passive income goals. So I don't need these crazy things. But anyway, that was going on.
It's nice to have that though. I mean, if somebody
definitely, it's definitely nice to have it.
Yeah, cool. So what are people's thoughts on that property doubles every?
Is that busted?
Yeah,
it's actually I actually didn't think it would be so easy to bust that one. I actually thought there would be a bit of a fight.
Well, I mean, so you could say property may double every 7 to 10 years, because if you really like, if you picked Hobart sort of around sort of 2014, 2015, you could have easily picked up something quite nice and even it's the same as Brisbane as well. If you picked up in Brisbane in 2017, 2018, you're absolutely probably laughing right now, as long as you've sort of bought an investment so you haven't, even if
like Kalanga in Queensland went up something absurd like 43% in a year. That's unreal.
Of course there is the opportunity, but who can actually say when that growth is going to occur? So anyway, what's your ones about? You can't get capital growth, and
did I make the banner? Make the banner. Click.
You already made it.
You can't have capital growth and cash flow. Myth. Is that a myth? Is it going to be busted, or is it going to be confirmed?
Yeah,
what are we going to do? So what we're going to do?
Hedge your bets, or put your bets on people, and we'll
Yeah,
sort of see where Joe goes with this.
Put your bets on. What we're going to do is run into our ad. But what I wanted to first talk about is that I'm going to go into a real life case study of a property that I've recently purchased to prove that you can have both capital growth and cash flow. And you can make it happen. Oh, we're getting a lot of bustards in here. Let's see how we go.
This live session is sponsored by Scott Agate from Hello House. Scott has created the world's first property negotiation as a service business. So what does that mean? Well, let's think about it. When was the last time you negotiated on anything over $100, let alone a property that is going to be one of the biggest investments of your life? The vendor, they have a trained negotiator on their side in the form of a real estate agent. That's kind of like you stepping into the ring with Mike Tyson after never training a day of boxing in your life. These guys are trained professionals, and that's what they do day in and day out. And this is what Hello House does every single day as well. They negotiate on property to get the best buy price from the real estate agents. Scott Agate, he's the expert negotiator. He has been in this industry since 1995. He owned and operated 3 Bell franchises. Scott was the guy that was teaching these real estate agents all these agent games. He knows all of their tricks. Having him on your side is going to give you a massive unfair advantage and literally save you tens of thousands of dollars. Unlike other ways of purchasing property, Scott's incentives are aligned with you, the buyer, meaning the more money he saves you, the more money he makes, which is what you want. You need to have those incentives aligned. Scott has kindly offered our group a massive discount on the retainer fee for his service. So if you're looking to buy your next home or investment property, click the link below to get in touch.
So we're in the process of getting that updated, of course. So I'm going to pop the Get Buyer Ready course, which is still which is a great opportunity for people to pick up that course and learn about it. So, but capital growth and cash flow, Joe.
Well,
what are we doing? What are we going here?
So I think this myth would have been this conversation would have been a lot harder to have in 2020, like before the biggest boom we've ever seen. Maybe not the biggest boom we've ever seen, but a massive boom. It would have been a much harder conversation to kind of argue, a harder point. So I think after seeing the Australian state, the country grow 21%, you have to agree that you can, if you bought in a cash flow area, then you're going to have done pretty well. So I guess the main thing is, what are we talking about here, right? We're talking about the typical go out super duper regional and get cash flow only, or go out there and buy blue chip, buy a unit in Bondi, buy a house in Bondi, have negative gearing, and then the capital growth will grow and you'll be making money, right? There's generally been 2 camps. And what we're saying is you can kind of merge the 2 of those together. One thing to mention as well is rental yield is not enough. If you just have a pure rental yield type asset, right? Let's just say you've got 6% and you're bringing in $5,000 a year. Okay. Amazing. $5,000. Well done. You're going to have like 20 of those properties to be able to go, right? Like to be able to retire, you need about 20 properties that bring in $5,000 net positive a year.
Assuming you don't pay down the debt, but it depends on how. I agree. It's tough.
How are you going to do that? You can't do that type of purchase anymore. There's no serviceability that's going to allow you to buy 6 properties. Now, if you start to go into the commercial space and start getting low doc and no doc loans, there's some possibility around that. But I guess we're just talking less sophisticated, everyday mum and dad property investors. The other one is blue chip, right? Do we go blue chip? I just want to buy Bondi Beach. I know everyone's always going to want to live there. It costs me, I know it's fine. It's 10 grand, 20 grand negative a year. That's absolutely fine because it's growing in value. One thing to also focus on it for that is how many of these blue chip properties can you afford? How many $10,000 and $20,000 can you have before you go broke? So this is where you need to kind of have a bit of a balance of them. And one of the big things that people are going to, talk to me say is like, no, but I'm saving money on tax. So I'm doing fine, right? Like I'm losing $1 here, but the government's giving me back 30 cents. So I'm sweet. I don't need to worry about that. But I guess kind of think about that for a little while. Like, is that return what you need? So yeah, I
what are
mean,
people's thoughts on negative gearing? Do we not the
oh God, do we? Yeah, is that a myth? No, I mean it works.
Well,
It works. It works. It does do its thing. And the thing is, we've got Jeremy Inazelli, an amazing accountant. I'm sure has some things to say on the topic. Watching right now. So anyway, that is mine. I believe that you can have capital growth and you can have cash flow as well. Jeff, can you bring up my screen on here and tell me when you see the little pretty house I have?
Oh yeah, I can see it. Do you want me to start adding it? Do you want me to add it to the
add it to the thing.
Okay. Yeah.
Add it to the screen.
Let's get us over here. There we go.
So this is a property that we purchased recently in South Australia. This was a mortgagee in possession. Now it's funny that we're talking about, interest rates crashing the market and people not being able to afford their mortgage. So this is before interest rates started to rise. But this is a 4-bed, 2-bath property. This is in South Australia, just an everyday, normal looking thing. Nothing special, nothing great, just a 4-bed, 2-bath property. One thing to notice is that we've got every room is a different color, which is always nice. And then we've got a smash window here. So the beauty of this was that smash window saved us about, $60,000. So what we did...
Why didn't they just repair the window?
I know. Why didn't they repair the window? But it's a mortgagee in possession. So the bank just can't be bothered. All we did was paint all the walls white. And we still haven't fixed the window. No, we got the glaze here in. We fixed the window. We purchased this property for $500. It was on RP data as $565,000 purchase price, like valuation. And all we did was paint the thing. If we look at what it looks like on paper, we ended up paying $508,000 for it. It's worth $565,000. Now, the person that I bought this for, the client that I bought this for, was a mortgage broker, and he got a bank valuation on it as well. Oh yeah, sorry.
Okay, back.
Okay. Yeah, so we purchased. Now it's too zoomed in. We purchased this for $508,000, and the bank valuation. So the bank, they did a full valuation. It came back with $565,000. So we made instant equity, 45,000 instant usable equity. So this person can go out there and use that and pull that money out to go use another deposit again. This property was sold initially in the 15th of November, 1995 for $90,000. Now, this suburb that I'm talking about isn't blue chip. It's not blue chip. It's everyday houses for everyday people. Can you see my spreadsheet? Yeah. Cool. Which was purchased. Current value, $508,000. Well, the current value is actually $565,000. That is 26 years have passed. That is an annual compound growth rate of 7.1%.
So it still didn't double. No, but I'm trying to prove my myth. Or prove my
7% double isn't 7.
It might actually be just double, because I think 7% is the 7% is the cutoff. I'm just doing the numbers now. Rule of 72.
Yeah.
You're right.
So we just made it. So we've doubled. Thank you. The biggest thing with this property is we are in a very tightly held rental market. We got $670 a week rent, which is a 6.9% return. So this person here has put down, so the client put down $134,000 in cash. We made them, we spent some money on, we spent $8,000 on reno. So minus that out of that, blah, 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 whatever, 500 and whatever. He spent $142,000. and he now has a property that is growing and is yielding him 6.9%, which is a positive cash flow of $6,000 a year. Like, this stuff is out there and it exists, and it's both capital growth at 7.1% growth rate and positive cash flow for him. Now, please do not come to me and ask for a 6.9% yield, because it's very, 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 very hard to find. But
well, it's hard to find with that sort of, where that's
6.9 is absolutely absurd. The reason why we did so well is because we bought so well as well. And actually, this is one of the things I wanted to talk about, right? You showed those statistics of Sydney crashing, right? It's coming off a high base, but it's only dropped $40,000. Like, this deal that I just bought.
Those are the capital cities, so I think it's dropped a little bit more than that. But yeah,
this property that we purchased, we got like a $50,000 reduction off, well, like what it's actually worth. So if you can buy well and property prices do dip a little bit, then you're absolutely fine, because in 30 years, it's going to be way better than it was before. So yeah, I guess that's agent cost.
Not financial advice, but yeah.
Yeah. And then, this is a good question here. Stamp duty, agent fees, agent costs, legals, etc., are all part of your capital purchase price.
They are.
Yeah, they are. Yeah. Yeah.
And so I suppose what they're saying is that should be included in the cost. Is that what I think that's what they're getting at, is it? Or
yeah. Rooming house can get both short term. Okay. Cool. Thanks, Brian. Where did actually? Oh yeah, there it is. So yeah, I mean, I spent more time on the other one than I had done on this.
The population.
That's pretty much all I've got from this one. But the supply is tight. The demand is still strong for this area, and it's still increasingly going up, and the valuation stacked up. And these type of deals are still out there. So one thing, I guess, the true message that I want people to get from this is, if you're ready to go to buy property, just go out there and do it. If property prices drop by 5%, it's really not that much money. But if they don't drop by 5%, if the supply of property that's not coming onto the market because there's no builders, like there's builders that are building and then there's builders that are collapsing, it aren't coming online. If there's 80,000 new people coming through the borders, international students are going to be coming back. There's going to be needing rental supply. So is it too much of a risk to not buy something and just kind of wait out later and see how we go? I don't know. It's kind of like COVID, right? COVID all over again.
I mean, I don't really worry too much about whether it's obviously there's probably markets you'd be sort of a little more hesitant, reluctant, and don't worry, I love Adelaide as a long-term perspective. But and even kind of parts of Brisbane, like, you've just seen phenomenal growth in those areas. Like, is that sort of, because I mean, ideally I want to see capital growth in the shorter term. You can never guarantee that, but I'd sort of want to get a bit more. But I suppose the thing is, I focus on when I'm actually in a position, my own position to buy, rather than sort of, then it's like, okay, well, which market do I like the look of at that time, rather than sort of saying, I'm going to wait for the property markets to drop.
And that's one thing that you do have to do, is move out of markets when they get too heavy in price. Like, when you've got to set a benchmark of, okay, well, once this area reaches, 700,000, I can't see value in it anymore. I don't see value anywhere, and you have to move out. The problem with doing that is you're constantly competing against hot buyers. So that's the struggle I deal with every day. But Sydney's Jeff just buying Sydney as Sydney's king.
This person obviously doesn't know how to spell my name, though. It's a bit disappointing. Still a unicorn deal. Well, I think
are there any more? Yeah, go on, mate. Sorry, you go.
I was going to say on that point, I think it's hard to get a deal like that to that point about it being a unicorn deal. I think the thing that people discount and don't consider is that if you're buying in a market where there's fundamentally demand, and will continue to be demand for that type of asset in that type of area. For example, the properties in a lot of have increased by $200,000 to $300,000, and the rents have certainly not. When I first bought this, we were looking at sort of yields of between sort of 4 to 4.5%, which is not fabulous, but it's not horrible. But if you look at the yield now, it depends on, but over time that rent will increase. So then if you look at that because rents are increasing, so rents will lag or can lag capital growth. So you can sort of see now that the capital growth sort of slowed off, rents are starting to catch up. Well, that's what I'm sort of seeing anyway, Joe. That's what, are you sort of seeing that as well? We're seeing that largely around the country in
seeing what? Sorry,
the increase of rents.
Yeah, well, it's I guess it's supply and demand, right? People they need a house to live, and they want to upgrade. Like, it's still people moving from one area to another. They kind of want to check the place out before they just buy a house there. So
it's sort of, it's difficult to borrow as much as what you want to be able to buy in that area. So you're sort of saying, yes, I'd like to buy in, I don't know, you'd like to buy in Bondi, just to keep using that example. But if I can only borrow 800,000, I'm getting a parking space in Bondi. So therefore, my alternative is I go and try and buy somewhere in an area that where I can pick some up for 800, or I can rent in Bondi. And then a lot of people might have that mindset to say, well, I want to live in this area, but I can't afford to buy. So the alternative is I rent, and I
rent vesting.
Yeah, potentially.
Yeah. Well, this is one of the things that I'm starting to see a little bit is, I can't borrow $1 million, but I can borrow 800,000. I'll buy there. I can't borrow 800,000. I can only borrow 700,000. You know what? I'm a little bit scared of buying a 700,000. I'm just going to buy a 600,000 just in case, things go a little bit sideways. I can't borrow a 600,000. I can borrow a 500,000. And then the next thing is like, well, how low can it go? Like, fundamentally, you're going to end up buying a house at the replacement cost of what it is to actually build a house on that. But the problem is, building a house is so very incredibly expensive right now that it's challenging. So how low can it go? Like, this is why I'm a little bit more worried about the top end of town, because it's easier to fall off that type of base. But when you're at the lower end of town, there's a little bit more there for you to
Yeah. So we promised a live Q&A. So let's get into it. There was some that Brian popped in, and there were some really crackers that Brian Happ, I think it's Happ, he put in. But have we got any live? If we do, then we can. So let's see.
Sorry. The question that he had was other myths you may consider. You can't retire comfortably on cash flow from 2 to 4 residential properties.
Interesting. That's kind of a myth, isn't it, as well? Potentially.
Yeah.
What do you reckon about that one, Joe?
It depends. I mean, it depends on the property, right? But absolutely, like we've built out plans where it's 4 to 5 properties, and you're able to retire on the number that you want. It's just making sure that they have the growth and have the yield there as well. So that's definitely. What are your thoughts on that one, Brian? I think you're listening, mate. What, you wrote that down? Do you think that that's a possibility or not?
Well, we're just going to have to wait for.
I don't know why I waited. I was like, I waited.
Wait for his comment. He might be watching a movie or enjoying some popcorn. But Joe, I'll jump in on that, because it kind of depends on your expectations, really. Because if somebody said it's a myth, is that Brian? Myth possible?
Myth possible.
If you want 2 or 300K passive residual, I don't like calling it passive. I like calling it residual, because I don't think any type of investing is rarely passive, or shouldn't be passive, even if you just have to make sure that. But yes, you can in the right property. I mean, let's kind of, you could, let's take out. If we take out if you take out the whole sort of, either commercial is probably not too far of the box, but if you look at kind of the co-living and NDIS, which yes, are higher cash flow, but for various reasons they're probably out of the scope of some investors, I'd say. If you're talking your stock standard buy and hold, I would say as long as you're not looking to get 2 or 300K, I think 2 or 3 you probably can, as long as you're happy with doing it over 20 to 25 years.
Yeah. Yeah. Yeah, 2 or 3. I think you need 4 or 5, more like it, to really make it cracking and happening. But we'll build it out and show you. Okay, the number of properties doesn't matter if you're getting $800 per week and you own it outright. Yeah, perfect example. Yeah, there you go. Perfect example. Well played. Whoever said that. Who said that? Can't see it.
I could tell you who it is. Hasn't popped up yet. But the one that I let's see. I'm just looking. There's a couple other questions that Brian also rooming house. Let's see. Mostly people saying busted.
Tom Gorman. Number of property doesn't
Tom.
matter. It's if you're getting $800 a week on the debt. Yeah, absolutely. And this is kind of how it happens, right? And this is why buying property in an inflationary environment is very, very interesting, because what you're doing is you're buying debt at today's dollars. So if I have 100,000, like we all agree, right? If I have $100,000 and I stuff that under my mattress, in 10 years' time, it's going to be worth less, right? I can't buy as much stuff because inflation has been eating it away. And where are we at inflation-wise? 6.1%. Let's say we put $500,000 under the mattress. We all agree inflation has eaten it away. It's not as valuable. Now, when we buy a property, we are buying debt and we are stuffing that debt under the mattress. So is it not to say the same that inflation is working with us rather than against us when you have debt? I'm not a mathematician and like total economist, but it's a nice little thought, right? Yeah. Anyway, sorry. Do go on. Okay, cool. Let's do some of these questions.
So there's there was another couple from there's a couple from Brian as well. He said banks don't want to lend you money once you reach 55. So I found that one was pretty interesting as well, because that's a type of one that I did come across a bit when I was in broking. And
okay.
And yes, I'd say it's a half myth, because it's a half myth. I'd say it's probably 75% myth. Let's go. I'm comfortable saying 75%. It's just harder. And you really need to know your credit policy. So you need to go to a really fantastic broker who knows knows how to structure the deal as well. If you are, because look, if it is an investment property, and it is, and there is, so you are still working and earn an income, it's not the size that matters, it's how it performs. Looking at the comments, but yeah, if you can sort of demonstrate that yes, it's an investment property, all those kind of good things, banks are still willing to, because people are living till 80 or 85, and even sort of a bit later now. So I think it is a myth. It needs to be sort of massaged a little bit harder. If you're, well, it sounds funny, a little bit harder. If you're over 55, you just need to sort of understand the right type of the way the deal is presented to the lender and the bank. And if it is your only asset, if it's a principal place of residence, then yes, it will be a lot more challenging, because banks typically don't like ending up on a current affair for repossessing somebody's home. So. Whereas if it's investment property, they can say, well, yes, this person can potentially sell that property to clear the debt if they needed to, if they fell into.
Yeah, okay, that's interesting. There was another myth that he had on there. What was
about
what
renters?
Was that one?
Saying that you shouldn't put up the market rent if you have good tenants. It's controversial. What are your thoughts on that, Joe?
Well, it's very hard. So, like, I was dealing with this exact situation purchasing a property recently. And what happened was it was super uncomfortable, because the woman was like, look, if you're going to buy this house, you have to take on the tenant, but you just need to promise me that you're going to have the tenant in here for a year, because that's probably how long they've got, right? Like, that's pretty much, like, they're very old, they don't have much left, but they can't afford market rent. So they can't afford the 480. They can only afford 410. So you have to agree to, take them on at this, which is like, wow, that really starts to tug at your heartstrings. What do you do in that situation? Like, do you want to, make the rest of someone's year life a misery because they need to fork out an extra $70 to afford to live? So, I mean, it's tough. Like, it's easy to say. It's very easy to say, no, screw them, right? That's the market renter. They can go live somewhere else. But when you start to really dig into the stories, because that's all property investing is. Like, it's dealing people to people. You're buying something off people and you're getting something off people and you're giving them money. And it's just a transaction. And it's just, yeah. So I don't know. I am all for raising rents when it's suitable, but there is also a human element. So I am, yeah, a little bit more, got a little bit more of a heart. But Jeff, what about you? Oh, stone cold Jeff Austin.
Oh, no. Yes, similar. I mean, when I sort of a lot of asking it to pay for.
This is a perfect one. Yeah, exactly. This is not my problem anymore. This is the vendor's problem because they are requesting me to do this, so I need to get a discount on the purchase price. And this is the situation that we didn't end up buying this property because they weren't willing to take that on. They were like, well, I'm not going to pay this person's $80 a week rent times by 52 or $70 or whatever it was. And we're like, well, I don't want to pay it either. Like, I don't have a relationship with them. You have the relationship with them. It's your responsibility. So we just walked away. Well, we did negotiate, but we walked away in the end. I need to.
Yeah, this is Brian. I need to work with Joe. Who said they need to work with Joe?
Work for me, please.
If the RBA increasing the cash rates slowly, shouldn't we pass on the love and do our bit for Australia? Yeah, I mean, it's a compelling argument, Brian. I mean, logically, it makes sense. But then I'm a bit of a softie. I don't. If somebody's sort of saying, and having grown up in a household where money wasn't completely abundant, you sit back and you sort of say, well, what impact am I having upon this family's life? And maybe some people will say, well, why is that my problem? And I say, well, yes, it might not necessarily be your problem, but you can, I mean, as long as you're not sort of taking the shirt off your own back necessarily. But yeah, I think there's room for some compromise and black and life is rarely black or white. I think bit philosophical, Joe.
Yeah, very philosophical, mate. Very philosophical. There was another question that came in. I don't know if this is a question, maybe it's just a comment. Increasing yield and immigration demands will kickstart the new property boom in the near future. The cost to construct will also contribute to this. Yeah, increasing yield and immigration demand will kickstart the next property boom. Yeah, I mean, we got a lot of people coming in. It's definitely going to increase a rental boom. You can't bring 80,000 people into Australia and not have houses for them when we're already at the lowest vacancy rates in history across our nation and not have that affect rents. And there will be a flow-on effect. Will it be instantaneous? I don't think so. But the people that are coming here, this 80,000 people are not, sweeping the floor McDonald's jobs. These are
skilled migration,
skilled migrants that have real money doing real things that are going to really nice locations to spend real money. So I'm all for it.
So yeah, David's asking this.
There you go. Do
you think there could be a boom 2.0 in a year or two? Too many variables.
Well, let's just go back. I mean, I'll share my screen again. Let's just go back in history and see what it actually looks like, right? So this is July 1992 to July 22. And these are the last booms that we've had. So we've had a resource boom from 2004 to 2011. Property prices from that period went up 215%. We had a dip down here for the GFC. So you'll see we had a GFC. It went down 7.5%. And then it started to climb up again. And then it's slow. Like this period here is, just boring and stagnant. Prices just aren't moving.
Consolidating, I suppose. Yeah. Maybe a little bit boring, but
consolidating, but you're not really gaining much. And this is why you need to have properties that look after themselves, right? That wash their own face. So they've got capital. So you've got some money coming in. So they're looking after themselves. but then you can hold them for the long term, because if you hold them for 10 years, look what we've got here. We've gone from, what is it, 400,000, oh no,
I
600,000.
love it how they pointed out that Labor loses government Tony Abbott elected PM, but there's no other. Oh yeah, they did mention coalition wins. There you go. Okay, so it wasn't.
Yeah, there you go. But this is where you'll see again the RBA announces cutting the rate from 4.75, but you didn't see a boom. Like, they cut the rates, you didn't see a boom of properties
Not straight away.
Straight away. And then there was another one. Investors reach a record high proportion of mortgage activities comprising 46% of mortgages. And then they put a cap on interest only loans. And that's where you saw the Sydney boom come off its peak. And then it was a bit slow for a couple of years. And now we started our COVID boom. So, I mean, what is this going to look like? Is it going to be a downturn like this? Is it going to be a downturn like this? Is it going to be a downturn like this? Is it going to be a downturn like this? There's no answers. If you're ready to buy,
what's a definition? Should we define what a boom is? Like, what is a boom? It's like a crash. Like like people say crash is 15%. I'm like, well, I don't think a crash is 15%. To me, I think there could be a positive market in a year or two. And when I say because a boom is boom conditions are what we saw in 2020 and 2021. I would say I think it's quite unlikely to see something like that for many years. I don't think we'll see conditions like that. If that's what I'm pretty comfortable probably saying that. And of course, there's always going to be suburbs and areas that will go against the grain. Like a lot of people are saying Perth, and I'll admit I don't know the Perth property market well enough to comment on whether there will be or there won't be. You may feel comfortable with that, Joe, but I don't really feel I know Perth that well as I could.
Yeah, it's a very interesting market. It's a market where I want to make money going in. I mean, I want to make money in every deal. Like, I've got clients that say, like, I've been buying in Perth, right? But it was a client that had a renovation at the front. You keep the front house, you renovate the front house, and you subdivide the block and you split the block. And you do that, right? That's how you make your money in that market. I'm very concerned about just buying, holding, and buying a perfect asset that's ready to go, and you just hold it and then it's done. There needs to be the extra value add, because I do see there's a lot of upside to Perth, but it's a little bit tough at the moment because, for the last 10 years, you look 10 years ago, like you did with your little chart, Jeff, the prices just haven't moved. So there are a lot of really good demand. There's a lot of demand drivers, supply constraints in the market, but it's
here we go. I like this clarification from Brian. So he's sort of saying boom to me is 10% per annum. Yeah, 10% sort of pretty good going. Sort of starting to. There will be markets within markets, not another nationwide. Yeah, big more segmentation.
I like that. Yeah, I like that. Anyway, cool. Well, I think that was a good little myth busting session. If you guys liked, Jeff and I don't really jump on these things by ourselves. It's always with a group, with a cool person that talks property, and we're going to continue doing that. Don't get me wrong, but if you enjoyed this one, let us know, because we will do more of them. That's about it. But yeah,
I think I've finally penciled in a session with me on a bit of my story in October. So I actually just have to sit down and map it all out. So
yeah, well, that's kind of David's been plugging us. He's very new here, but he's been plugging this quite a bit. So you'll get a bit of a Jeff story in the next couple of weeks.
We'll just say it's multi-million dollars, so people can. It's multiple.
So we'll go through a bit of the stories. I've covered off my story in these sessions before, so we'll do that. And so tune in. Don't just tune in. Where did David's comment was? I'm new here. So awesome. Welcome. Great to have all the new people, which is cool. We'll I think it will be cool to cover off your story and cover off the developments that you've done as well, and what you're kind of planning going forward as well.
Yeah, I think we need more than one session for the story, Joe. So if you want to, because otherwise then I have to. I mean, I could give you the go to woe if you want.
If you guys like this, let us know. Thank you everyone that showed up. If there's any other questions, throw them in now. Any myth busting? I think we've busted enough here. Let's go buy a property.
Thanks to the audience. Yeah, I'm excited, and thanks for if you want to let's see. I like these types of spitballs. So no right answers, but topics to research further. Yeah, fantastic comment. Thanks, Brian, as well. Thank you for being a supporter. If you want to, I'll give Joe a bit of a plug. If you want to, he's really making stuff happen around the place. Property Principles is his gig, so check him out if you want to sort of learn more about buying property. And just buying sort of A grade properties, or not just the ones that you sort of see everybody else buy. So check out Joe if you want to. And he's pretty busy though, I think.
Just simmer down, people. Don't come to me. I've got enough time. I don't want any more.
Sorry, Joe. Maybe yeah. But you are quite busy.
I don't want any more people.
Yeah.
But no.
Thanks. And good insights. Always nice to see facts and charts.
Yeah.
Appreciate it. Thanks, everybody.
I think that was RP Data doing its thing. Thank you very much, guys. Have a great evening, and we will catch up soon. Let's go buy a property. Thank you.
See, I'm about to leave the studio. I got to press the hit.